I'm Olivia Voznenko.
I'm Steve Guilfoyle. We are back.
Yes, we are. All right, we're warming up. Hit me with some NATO, Stephen. Let's go. Come on. Viewers need to hear you.
How about this?
It's been a while.
All right. President goes to Europe. All the little NATO allies are scurrying for cover because the president is right. Outside of Canada, well, forget about Canada. They're only paying about 1.2% of GDP. Outside of Poland, outside of Estonia, outside of the UK, not a whole lot of folks in the NATO alliance are paying their bills. You and I and Jimmy Sweeney right there behind the camera are paying our bills when we pay our taxes.
Okay, so can we just pause, rewind? When did we allow this to happen?
Oh.
How long have people been taking advantage? Whose fault is it? That's what I'm saying. I'm lost here.
All right, well, they haven't been paying their fair share, our allies, for a long time. I'm an old Cold Warrior myself. Even back in the day, we were paying the bills. I used to train with the Royal Marines, and it was all U.S. paid for, whether it was U.S. Marines or Royal Marines participating.
Okay.
But the deal was struck in 2014 where all the NATO allies agreed to get their portion of GDP spending up to 2% towards defense.
Which they haven't.
Which they haven't. They have some time to do so, but they have to be showing progress. And some of them are. But some of them, such as Canada and such as Germany, have stated that they really have no interest in ever getting to that 2% level.
So why is everyone up in arms, no pun intended, about this? Get it, NATO arms?
Well, because the U.S. is paying 70% of the freight for NATO. And it's not fair. It's not fair to the U.S. taxpayer. And we have a president who, you may have noticed, when something isn't fair to the United States, he's not shy about it.
Which, let's talk about China.
Well, we can talk about China, which is a whole different ballgame. This morning, you saw the president, well, not the president, the U.S. trade representative was told to prepare the way for another $200 billion worth of U.S.
And it's going to be
tariffs.
Consumer goods.
Right, it can be consumer goods, but this is only a 10% tariff.
Okay.
This is not a 25% tariff like the first $50 billion.
Okay.
And this is something that China can't possibly keep up with us on. This is something, they can't go tit for tat here. They only have after the first $50 billion worth of tariffs, China can only go another 79
That's
or
what I'm
so
saying.
billion.
Why are they retaliating if they're apparently taking advantage of us?
They're going to have to become creative to retaliate. And let's be honest, they're going to run out of ammo. They can't keep up with the United States. And now, trade wars are ugly and they're going to hurt. I'm not saying this is painless. I'm not saying that in the least. It's going to hurt you. It's going to hurt me. But this is winnable. This is winnable in, I believe, maybe not the immediate term, but in the medium term. Maybe within 6 months to a year, the U.S. can bring China to capitulation, as well as several of our other allies on trade.
Will they be our friend?
There's going to be hard feelings, no doubt about it. China has become used to taxing other countries at 25% while only being taxed at 2%. China has become used to stealing, actually thievery, of U.S. intellectual property rights. And that's coming to a screeching halt. They can't be happy about it. One advantage China does have, they have a leader for life. The guy cannot be replaced. Mm-hmm. We have a leader with an expiration date. Even if he gets reelected, it's another 6 years. If he doesn't, it's only 2 years. And he has to face midterm elections for his party in just a few months.
Okay, so we're not going to see an impact in the near term for this.
You won't see any impact in this.
This round of earnings, is anything going to be affected by the trade
Earnings
war?
are historical. You might have seen a slowing in capital spending, something like that, as firms prepare for the trade wars, but you won't see anything in the numbers. Where you will see it is in forward guidance, where the firms, when they have their calls after the numbers come out and they explain things to the media, this is what they'll have to explain.
And that's going to be super important on Friday when we hear from the banks.
Yeah, you're right. The banks, now, earnings in general, maybe 19, 20% growth on top of the growth we had last quarter. So earnings are hot as heck, which is why stocks have really, and let's not forget the buyback factor. So we have a bid under the market. While we've gone sideways here with all the trade tensions of the first half of the year, there's been a bid under the market as well.
Yeah.
So even though we feel like it's been volatile within a range. So it's nothing that we've had to really deal with too much. And that volatility will help the banks out.
Right, but we talked about buybacks. I mean, I don't know. I feel like buybacks are sketchy. I understand if you own a position, it's great, but isn't it kind of phony?
If you're a senior executive too, or a CEO.
But isn't it phony?
Well, the monetary policy of the last 10 years throughout the entire Obama administration was sketchy. It was designed just to support the marketplace and to support risk assets.
Right.
So the market itself has not truly been a free market for a long time. And it's really well within reason for a corporation, when they have cash on hand, when they have the ability to do so, to buy back their own shares. And with these tax cuts that all these corporations have benefited from, they also saw the internationals also the ability to bring back large amounts of cash. We saw Apple, right? Was that $100 billion buyback?
True that.
Which is a large portion of the overall buyback picture.
But back to the banks, because they had a buybacks last week or whenever, not last week, I feel like it's been a long time after the car. But really, let's talk that. I don't understand. A lot of these banks are supposedly going to report low trading revenue.
I don't think so. I think that's going to be on a case-by-case basis.
Really?
I think I'm long Goldman. I've been wrong about the banks in June. I told you people I was buying the banks in June. I actually advised you to. Mm-hmm. That was wrong. All right. I manage my costs through the selling of puts, so I'm kind of all right here, but I'm a little bit under in Goldman Sachs. I'm also long Citi. I'm also long J.P. Morgan. I've managed those much better, but Goldman Sachs, I'm a little bit underwater, and I'm really hoping that we do see something positive on the trading side from a firm like Goldman, because if Goldman can't trade the environment,
that's bad.
Then no one can.
That's bad news.
They've been the evil empire forever.
Investment banking. What did you just say?
Goldman. When I was a kid working
empire.
for Credit Suisse, Goldman was always the big bad guy we had to compete with.
They should know everything. But okay, investment banking.
Well, that's huge. Yeah.
IPOs.
The IPO market was the hottest it's been in 3 or 4 years just this past quarter. So we're going to see nice numbers for Morgan Stanley, for Goldman Sachs, for J.P. Morgan in that area.
Okay.
We also want to see loan growth, consumer loan growth.
That's
where the Wells Fargos and the Bank Americas and the Citigroups will have to look for some help.
But what about the yield curve?
The yield curve's a problem.
That's a problem.
It's a real problem. And we see pressure on the long end of the yield curve today, because of the trade tensions. People are betting against long-term growth and inflation. So that's a little bit of a problem. And the Fed, speaking of inflation, if we get CPI numbers that are a little on the hot side like the PPI was, then the Fed will be forced to carry on with that fourth rate hike in December, which pushes the short end of the curve higher. You get that inversion, then you're probably looking at 1 year to 2 years before a recession.
Oh, man. But we have some time.
We have some time.
So what do you do?
And we're still running at 26 basis points. It's not like we're running at 0. It's not imminent. But I don't like 26 basis points. You used to ask me when we first started working together, you asked me what was good for the banks, and I used to tell you 80 basis points.
80 basis points. Okay, we're a little off on that one.
That's when we were trying to hold the line around 60 when I told you that, I think. But it's 60 would be nice at this point. So would 40.
Right, but that's not, I don't know. Okay, so earnings season, you're cool with it?
I think we're looking at another 19 to 20% on earnings growth. I think we're looking at 9% on revenue growth. It's going to be a good season, but like I said, that's historic.
Do you like to buy it right ahead of earnings? Just a quick note for...
Not generally. I like to look at the way stocks have been behaving, believe it or not. And if an individual stock that I'm interested in has been running its earnings, I will not jump on the moving train.
You behave, stocks, because Stephen Guilfoyle says you need to be disciplined, all right?
But if a stock comes in ahead of earnings, and I like the name, and it gets to one of my levels, I probably will tiptoe in, because there's just so often a reversion to mean after the numbers come out.
All right. Sounds good.
Sounds
good, Stephen. Welcome back. Thanks for welcoming us back, guys. And we should see you soon, right?
Thanks for watching Street Smarts.
Bye.